Welcome. Thank you, everyone, for joining me here this evening. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. Tonight's presentation is a very simple presentation doing a comparison in the income and capital gains taxes between Australia and the United States. So let's get into it. Okay, of course, no presentation would be complete without some disclosures that this does not constitute personal advice. You do well to seek out engagement with an international CPA financial advisor who is knowledgeable in these areas. I should mention also that all of our presentations are recorded. You can find them on our YouTube channel, which you'll see right there. There's actually many dozens of different presentations that are available there. Subscribers are up, thanks to all of who have subscribed to my channel. And the most recent recording that's up is you might say the virtual blog entry, the fifth one in a series, talking about how I moved my family from from the US to Australia and then back again, and all of the ins and outs involved with that. A little bit about me. So I was really called to be a financial advisor. It was 2002. I came into a little bit of money, went and shopped for a financial advisor in Australia, and I was confronted with nothing but salesmen. And being someone at university studying business and IT, I thought this is an industry ripe to be turned into a profession. And so it wasn't until 2008, when I'd been living in the US for a couple of years, I'd been working in corporate finance jobs at that time. I went to an information session hosted by UC Berkeley Extension, and they spoke about this type of financial advisor called a registered investment advisor that come from a professional background, that have a fiduciary standard of care, the highest legal standard of care, and that really appealed to me. So in 2010, I launched my career. Arete Wealth Strategists actually celebrated its 10th anniversary just a month ago, so we're very proud to be serving our clients. Kinds of issues we assist folks with are described here. So an example would be an Australian business owner living in the US who has the goals perhaps of selling their business and moving back to Australia. There's some examples there of what we're able to achieve for that family. A different family, a high net worth Australian family currently living in the US, thinking about how they avoid being subject to the US exit tax, something that I've done a couple webinars on, and I'll do another one on. It's a very popular topic, but we were able to take some well-timed action on their behalf to avoid them being subject to that, saving millions of dollars in exposure to that exit tax. Lastly is an Australian executive who moved his family from Sydney to the US, who enjoyed a fruitful and well-remunerated career as an executive, who wanted some assistance tying up all of his loose ends, handling investment real estate, inheritances, superannuation accounts, all those kinds of things, to get settled in the US and enjoy his retirement in the US, which he and his family are presently doing. Okay, so tonight's presentation, here is what I have for you. So I'm going to first be talking at a philosophical level about the difference between a rules and principles-based taxation system. And of course, Australia has a principles-based system. The US has a rules-based system. I'll get more into that in a minute. Australia has tax, the US has taxes, and that you could really think of as a corollary of the first point. We're going to talk about filing statuses and the difference in what that means between Australia and the US. We're going to do a comparison of marginal rates, actually quite a detailed comparison of marginal rates, because a comparison of marginal rates really isn't sufficient to get to what your actual tax payable is. There's other things that need to be included, such as your itemized deductions or standard deduction if you don't qualify for itemized deductions, as well as state tax rates, payroll taxes, a whole host of things that we'll be going into. Differences in approach to the taxation of capital gains. So I'll go through, talk about how Australia does that versus the US. I won't be using an example in quite the same way, but rather different levels of gain. So $10,000 gain, $100,000 gain, $1 million gain, what is your capital gains exposure going to be? And we'll point out some interesting crossover points where capital gains does, in fact, end up being slightly more expensive in the US for a very large gain. And then lastly, we'll be talking about differences in deductions. Won't be covering credits, actually, but just differences in deductions. I would also like to mention that I like to make this interactive. So if you've made the time to be here live, then I want you to be able to just chat in and say, hey, Ash, hold on, I have a question about this, that, or the other, and we can make it lively, because if you have a question, you can be pretty sure that one of the several dozen other people on tonight's call might also have the same question. Okay, so let's get into this, shall we? First point is to do with the rules and principles-based system, the difference here. Now, you might say, what does this have to do with me? It's a foundational philosophical understanding to have here, and that is the US operates a rules-based system, and that is there are specific rules and regulations to determine how much a taxpayer owes. If there is something written down that says, if you own this type of account or have this type of gain, you owe this tax, it's very clear. If you had a very similar situation that is not specifically referenced, you're in the clear. There may be a different tax treatment that applies to your type of gain. And this is where a rules-based system breeds tremendous complexity, as we'll see on the next slide. A principles-based approach, on the other hand, relies on a general set of principles to guide tax policy. You look at the ITAA of 97, and that sets out the general principles of Australian taxation. I have an example of this with a client from a couple of years ago, a tech exec who did very well, made a couple million on his equity compensation, was moving back to Australia through his company. He had in-house tax counsel through PricewaterhouseCoopers, and who've recently been in hot water in Australia, but that's another topic. So he received guidance from the folks at PwC that said, if you have a gain attributable to foreign exchange, we were in a time when the Aussie dollar was strengthening, the US dollar was weakening, so thus his holdings that were sitting there were just increasing in value all the time by virtue of foreign exchange. Turns out there's a rule that Australia has that deals with this, and it's something that becomes more applicable for high net worth individuals, but and the sums aren't strictly defined, but it's thought to be in the high hundreds of thousands of dollars of assets, and therefore probably tens of thousands of dollars of gain. My point is, when I took a first read of this, I said, hey, we don't have a problem here. Your investments are sitting in a brokerage account, and the law with what I'm reading here, it says if it's in a bank account, we're in the clear, nothing to worry about. PwC got back to us and said, no, that's a typical American approach that leads to an incorrect answer, because while they may say gains in a bank account, they actually mean they're applying a principle. They're saying really gains anywhere. We don't care what type of account it is. If you have a gain, we're going to tax it, because that's the principle that we're trying to apply here. We're not going to list every conceivable type of account one may possibly hold foreign currency in. We're just going to say it's a bank account or the like, and it covers everything. So rules versus principles. A comparison here, and this is an important takeaway for those planning their tax futures in the United States. The rules-based approach, while it may result in higher certainty, and it does result in lower flexibility, certainly higher complexity, as indicated a moment ago with the 70,000 pages in the Internal Revenue Code, and the compliance costs to find accountants that even know all of the rules can be very challenging. And this is where Aussies come unstuck, is they'll move to the US, they bring this Australian mentality with them, and they'd say, oh, I'm just going to get someone down at H&R Block to complete my tax return, because how complicated could it be? Well, that's the thing, is in a principles-based system, it's really not that complicated unless you've got some esoteric, business sale or business taxes or something like this in Australia. In the US, however, almost always when you have a cross-border individual, namely an Australian in America or an American in Australia, there are special rules that apply. And I'm referring to FBARs. That's pretty straightforward, the Foreign Bank Account Reporting. There's FATCA, the Foreign Account Transaction Compliance Act. There's PFIC rules. That's a nightmare, an absolute nightmare. And if you don't have a qualified accountant who knows about this stuff, then you could be in real hot water with the PFIC rules. So the compliance cost, that's another thing you have to watch out for. Moving on here, let's make a comparison. In Australia, people talk about, oh, I paid this much in tax. I noticed this. I was back there, as I mentioned, for 2.5 years, and it struck me. In the US, they definitely say, I pay too much in taxes, plural, tax and taxes. Well, why is that? We see on this demo pay stub on the right-hand side here, I don't have a client called Jack Black who lives on Jet Street. This is just a demo. You can see here that there's a single line for pay-as-you-go tax. That's it. There is some sort of manual adjustment where they were withheld on this example, but there's basically, there's your tax. That's it. Here's your superannuation deduction. That's it. And this is your net pay. It really is as simple as that. Now in the US, not so simple. Let's see what we've got here. We've got a demo. This is, again, not one of my clients. This is just an internet search revealed a demo pay stub from someone in New York in sometime in the 2000s. Let's take a look. What do we see here? There's gross pay, of course. And then under that, we've got federal income tax. Let's counter up. Federal income tax, state income tax, New York City tax. Let's not forget our payroll taxes. Here's Social Security, here's Medicare, and we've got state unemployment insurance and state disability. Now, that's not much. That's not going to break the bank, $1.20 there, but you can see there are all these different things in there to understand. Someone's written in with a Q&A. Russell writes, PFIC, I'm sorry, Russell have done webinars, and I mean plural webinars on this. PFIC refers to the passive foreign investment company rules. The short story with PFICs is you cannot, if you're a US tax resident, which means you're a citizen, a green card holder, or a US tax resident by virtue of what's called the substantial presence test, that is more than 183 days in the current year, or a sliding scale going back 3 years, which means if you spend more than 122 days over in that fourth year, then you'll be considered a US substantial presence taxpayer. If you hold foreign denominated investments, namely, let's say you held an Australian managed fund or an ETF in your brokerage account at ComSec or wherever, the US would take a dim view of that. They would say, hold on a minute, what's this thing? You need to report your taxes on a worldwide basis, being a US tax resident, just as you do as an Australian resident, but it's a little bit more complicated. And so they're gonna tax that at a punitive rate, and once a PFIC, always a PFIC, and the tax compliance costs are horrific as well. I have a white paper on my website. Feel free to check it out to learn more about PFICs. Super is not included unless you have what's called a foreign grantor trust. There was someone who emailed me over the weekend about this. Actually, they have a self-managed super fund moving to the US, but unfortunately, that simply doesn't work. And the reason for that, it can work, but with one important caveat, and that is self-managed super funds don't work unless you have an Australian trustee. So that's either going to be another family member or a professional trustee. When you put a professional trustee in there, the costs begin to add up, and unless it's a substantial amount of money that's already in there, then the cost of the professional trustee may make that not worthwhile. But in either case, actually, I've done webinars about this topic as well. If you've got a super account that's deemed a foreign grantor trust, excuse me, then you've got problems, because the investments held within that do attract PFIC treatment. Whereas if you've got the more mainstream employee grantor trust, where you don't have much control, you've contributed less than 50% of the total account balance, you haven't rolled it over in the time that you've been a US tax resident, things of this nature, then you don't have to worry about it. So in my example, for instance, I left Australia when I was 23. I had all of, I think it's like $2,500 in my super account. And I never contributed anything to that balance. That's an employee grantor trust just sitting there, accumulating and accumulating, doing its thing. So I'm not particularly worried about that. Now, in the 2.5 years I was back in Australia, had I dumped a bunch of money back in that super account, that would have flipped it, because it would have meant that more than 50% of the contributions were my personal contributions and not superannuation guarantee contributions. And that would then have turned it into a foreign grantor trust. So good thing I didn't do that. Okay, so back here to the point I'm making. So there's a whole bunch of different taxes, and so Americans aren't misspeaking when they refer to paying too much in taxes, because there's all these different things to consider. Differences in filing status. Let's talk about this. So anyone that's been in the US for a little while will have some insight as to what I'm talking about here. But in the US, you've got 5 different filing statuses, and it's really governed by certain life factors, namely your marital status, whether you're a widow or widower, or whether you're what's deemed a head of household. That would be a single parent in this instance. Okay, so the single excuse me, I forgot married filing separately. This is a funny one. Married filing separately, I can just about guarantee that I'm going to help someone out here with a conversation at the next cocktail party you're at, when someone is sounding too clever by half and they're saying, I'm going to file married filing separately because I've got student loans in my name and my partner doesn't, and they only tax mine, blah, 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 blah. Okay, wait until we see those tax rates that apply to married filing separately. There are very, very few, I mean, literally only one example I can think of where married filing separately could, in theory, actually be superior, but it almost never is. Okay, so here are the 5 filing statuses that we have in the US. You can see here a screenshot that I took from TurboTax to show you what those rates are that are applicable. So if you're a single individual, these are your rates, running from the lowest, which is 10%, all the way up to the 37% bracket. What I see, I would say in 98% of my client base, I see single and married filing joint, or actually widower. I think it's 100% now of my clients fall into the first 2 of these brackets. Married filing separately, as I said, there's only ever one circumstance where I've seen that make sense. And head of household, that's more your single parent with dependents that they're able to claim. Okay, married filing separately. I just want to point this out because there's a lot of numbers and a lot of brackets on this screen here. But take a look. If you're married filing jointly, you have to be earning above 647 to hit that 37% bracket. It is almost half that. It's exactly half, I think, there with the married filing separately. So you could say that's fair, but it's really not that fair, because look what it is for singles. If you're a single filer, you actually get up to 539, 900 before you're in the 37% bracket. So the married filing separately tax bracket, tax filing status, excuse me, is a little punitive. And that's not the only way in which it's punitive. There are a host of other deductions and so forth that you lose. It's bad news. Generally speaking, what are we seeing here? So as we work our way up from the 10 to the 12 to the 22 to the 32, we're seeing a pretty even doubling. It's more at that higher income level that it's, otherwise it'd be $1,040,000, sorry, $1,080,000 if you hit the 37% bracket, but clearly it's not as high as that. So this is what we have in the US. No need to belabor this point. What do we have here in Australia? Australia doesn't really do filing statuses. Everyone is a single filer, and we can all make our comments on this. Personally, I think it's pretty unfair. I think it disincentivizes the breadwinner, be that the male or the female or whoever it is in the couple, it disincentivizes and is punitive towards that kind of household. So the optimal to make use of the tax brackets in Australia, you really want both people to be earning about the same amount. That way you don't have slack or unused marginal tax bracket in either spouse's name. So Australia does have an interesting difference, and that is, unlike the US, Australia has this resident versus non-resident tax rates. And those that have been following me for some time will know how this gets me animated when talking about so-called Australian investment property when held by non-residents. And just saying that, I'm sure I'll get a comment or two. People say, hold on, what are you talking about? Well, here's the thing. I'm going to let you answer your own question here. If you're a non-resident, what happens? Firstly, non-resident, look at this. From the very first dollar, they own 32.5% to the ATO. Now, it comes into parity at $180,000. So you've had a flat rate of 32.5% until you hit 180, where everyone's paying 37%. Everyone's paying 45% above $180,000. Excuse me, I misspoke. Sorry, it's actually 37%. That at 120 is where parity is reached. So it's really on that first $45,000 of income where there is significantly more being paid. So that's the first thing, is that you're paying more on the first tens of thousands of dollars of income. That's the first point. And the second point, which is far more substantive, and that is a non-resident taxpayer does not get the 50% capital gains tax concession. This is a slide I've got coming up later, but the way capital gains works in Australia is you get half of your marginal rate. Now, really, that's residents get half of their marginal rate. So that means, excluding the Medicare levy, that a high income earner above 180,000 Australian dollars is paying 22.5% long-term capital gains, which, as you'll see later on, is actually lower than what the highest capital gains rate is in the US, but not by much. It's not worth getting especially excited about because it's only 1.3%. So the non-resident, going back to what I was saying, if you own property or any other Australian taxable property, property in a broader sense, could be investments of any kind, stocks, businesses, etc., then you don't get that. You're paying these rates on capital gains for that Australian taxable property. That is massive. And people say, actually, someone wrote in immediately before the webinar with a question, and they said, well, hold on, if we've had this investment property since 2000, what's the treatment going to be? Bad news. Well, people naively think, oh, I'll wait till I move back to Australia and then I'll get residence treatment on the whole gain. Wrong. Doesn't work like that. The ATO are smarter than that. They say, sure, you're welcome to move back, do whatever you want to do, but we're going to partition the gain from the time you purchased the asset to the time you returned as a resident. The gain that accrued over that entire 23-year period that you were overseas and a non-resident is taxed at the non-resident rate. And that itty bitty little bit of gain that's happened since you moved back, we'll tax that at the concessional domestic rates. Margot, how are you doing, Margot? Good to see you here. Just for people to know, Australian Treasury is conducting a consultation, submitted due by 22nd of September, on the individual tax residency framework. Some proposed rules may have a detrimental impact on some individuals depending on their circumstances. Various information analyses available online. Thank you very much. Appreciate the public service announcement. Thank you. Okay, moving on here. Next slide. So, comparison of marginal rates here. What we're looking at is a single versus married filing joint. I tried to make this a little bit more legible. We already saw this earlier on when I had all of the rates up, but let me just slow down for a second here to let you take that in while I read this question from Brett. Brett writes, if non-resident, most likely you're probably earning more than $45,000 in the resident country. So not so bad, as what you pay in Australia will be credited to US tax debt, correct? If I understand it correctly, and it's a big caveat, there's a little asterisk I'm putting over there. If I understand you correctly, if non-resident, most likely you're probably earning more than 45,000 in the resident country. Where is this 45 coming from? Okay, 45. Well, here's the thing, Brett. This comes back to some slides that I deleted from tonight's presentation because I thought there's only so much talk about tax that anyone can stand at the best of times, let alone late in the evening. And that's to do with source of income. Brett, if you're in the United States and you're working, Australia has nothing to do with taxing that income. On the flip side, however, if you are an American citizen or green card holder in Australia and you're working in Australia, you still have to file your US taxes to see if you have a tax obligation to the US. So there is an asymmetry there. There's an unfairness. The US will tax you whether you go to Antarctica or Zimbabwe or anywhere in between. Australia, on the other hand, they say, well, see you later, mate. Have a good time overseas. Enjoy yourself. We hope you bring back lots of money so we can tax it later on. But the only thing we're going to tax you on while you're away is what's called Australian sourced income. So that would be Australian investment property. If you own a business that's registered out of Australia, if you have trust income out of Australia, things that have to be deemed to be quote unquote sourced from Australia. So the question kind of doesn't make sense because you wouldn't be paying Australian non-resident rates if you're overseas unless you had Australian sourced income. I apologize, you may have already understood that. But anyway, if you earn that same money in the US, you would already be in a higher bracket. $45,000. Yeah, let's see. So you're making 40. Well, technically you're right, but your total tax bill might actually be, or would almost certainly be lower in the US, assuming you're not living in Manhattan. We'll get to Manhattan. And there's reasons for that I'll go into because it gets complicated. There's filing status. There's also what's called your effective rate versus your marginal rate. And so to use your example, Brett, the Australian taxpayer, let's go back here. The Australian taxpayer is paid 19% from 18,200 to 45,000. So they've been in a 19% bracket. Technically, you got me. You did get me because the US person at $45,000, they are $275. They're paying 3% more on $275, but their effective rate, that's the total amount of tax paid divided by the taxable income, is definitely going to be lower on the US because they've been paying 12% from 11 up to 44. So 7% less in that example. Plus they get a standard deduction. If they're a single filer, that's $12,000. I believe it's $12,750. That's immediately taken off their taxable income. So they're going to be ending up paying less in the US. But you got me? Yes. Technically, that individual would be in a slightly higher bracket for a very small amount of money. Okay, moving on. Here are the tax rates. Oh, you know what? Sorry, I want to go back. I want to go back here and show you something. And I've got a detailed chart coming up on this a little bit later. Annoyingly, the US does not have their long-term capital gains brackets fall neatly into the tax brackets. It's kind of somewhere in between. So you see in microscopic font here, in the 12% bracket, if you make under as a single filer, under 44,625 or 89,250 as a married filing joint filer, you're in a 0% bracket. That's happy days. But remember that the gain gets added to your adjusted gross income. So you'll see later in my examples, if you have $100,000 gain, some clever pants out there might say, well, isn't that awesome? If you structure your tax affairs correctly in the US, you could pay 0% on that. Wrong, because your $100,000 is added to your AGI. So it is impossible, as far as I'm aware. Maybe there's a CPA out there that would say through a combination of credits and this and that and the other, it is possible. But just looking at it on the surface, you could not possibly have a $100,000 gain and still be in a 0% bracket, because your AGI, your adjusted gross income, which is a higher number than your taxable income, would be in excess of that threshold. The other place we see this is at the other end of the income scale. If you're making good money, if you're making above 492,301 as a single filer and 523,051 as married filing joint, you're in a 20% federal long-term capital gains bracket. Okay, so Jeff has written in, okay, Ashley, I've got to drop, but, well, in that case, I feel bad answering his question if he's not here. Maybe he's holding on for another minute. I've got to drop, but American husband and Aussie wife. Yep. Okay. We are moving back there. Well, where's there? Okay. And we'll have a business in the US and a business in Australia. I'm thinking we need to talk soon. Well, I'd certainly welcome that opportunity. Okay. So back here to the tax rates. Let's move on. So here we have the Australian tax rates yet again, in comparison to the US rates. So just some commentary. Yes, the marginal rates are higher in Australia, 45% at 180. That's the thing. I say there's an unholy trinity of tax impacts. It's like a left-right combo when you get back to Australia that can be a knockout. And that is, especially for people in the tech sector. I don't know why tech so much, but I've just seen it time and time again. People in the tech sector, when they move back to Australia, they make a lower amount in nominal dollars. The same job, doing the same thing day in, day out, just pays less in Australian dollars. Then you've got the currency effect of Australian dollars. Then you've got the brackets that are higher that kick in earlier. So this is, as I was saying, that combination, that knockout combo. There was another chat here. Oh, thanks for being with you. Okay, great. So we don't like that. Australia, you're going to pay more tax, but I want to defend Australia. You get a lot more for your money. You get healthcare. You get quality public education. You get tertiary education at a significantly lower cost than the US. The other thing to remember here, not unlike for my long-term viewers, not unlike the Morningstar Global Investor Fund Experience study that compares the total cost that you'd pay as investing in a managed fund or a mutual fund. This analysis here is incomplete because it doesn't really include all the real world factors. And in that aforementioned study I was just alluding to, they don't talk about custodial fees, brokerage fees that you have to pay in Australia. They're just looking purely at management expense ratios. But I digress. So here we're not comparing payroll taxes, state taxes, or local taxes. I'm going to take you through what's going to be 8 slides here, doing a comparison of some taxpayers and the income and the tax that we expect them to pay. So this is a super simplified example here. I use Smart Asset, which has a pretty good basic, illustrative tax calculator in the US, and Money Smart, which is actually a government-sponsored website in Australia. They sound very similar, Smart Asset, Money Smart, but the Money Smart is a government-sponsored website in Australia. So let's talk about a single taxpayer making $250,000 a year. One inconsistency already, before we even get past that first line, is we have to control for currency. So that's 250,000 US dollars versus 250,000 Australian dollars. At today's exchange rates, 250,000 US dollars is probably worth about 350,000 Australian dollars. So I just wanted to point that out, first of all, because I am well aware of that. So living in Manhattan is very important. Manhattan actually has a local tax. Let's run through it. So they pay their federal taxes at the marginal rate of 35%. They've got their FICA, which is your payroll tax, your Medicare and Social Security. State taxes, New York, they need to get paid, and then city taxes. Add it all up, you're paying $94,000, or an effective tax rate of 37.6%. Whoa. Okay, New York. They've seen Gossip Girl, they've seen Suits, they want to live in the Big Apple, the Big Smoke. Well, just beware, you're going to get hosed. It's one of the least tax efficient places to live. There are also taxes and everything, of course. You got to follow the opportunities, and oftentimes this is where the high paying jobs are located. So you can't necessarily beat it. So someone who's single in Australia making 250, let's walk through that. The tax calculations are a lot simpler using Money Smart here. So they just pay their $83,000 in income tax. They like to be tricky with this word levy as if it's not a tax, but it is a tax. So I added that up. We get 88,000. So an effective tax rate of 35.3 in Australia. So seemingly here, if you're living in Manhattan, making 250, you're paying more. And it's true, you are paying more. But if you took your 155,904 back to Australia, you would have something like $210,000. So you might still be better off, assuming you got paid the same amount for the same job. Next, what if you didn't live in Manhattan? Instead, you lived in a state with no state or local taxes. Suddenly, the tables turn, and quite dramatically. So we can see the same individuals making 250 if they're in a state like Florida, Texas, Washington State, Nevada, although Washington State did just introduce this nasty capital gains tax on those making more than $250,000. Sorry, that have, making more than 250, they get hit with a special state level tax. But nevertheless, your average rate of tax for that 250 earned is only 28%. So it's looking better. Now let's compare a married filing joint taxpayer. This is where things get way, way better, as you'll see on the next slide. So the married filing joint taxpayer, they're not living in the lap of luxury in New York. I hate to say it. I don't mean to be elitist in any way, but in New York, making 250, married filing joint, that's both spouses working there, making 250. It's good, but the cost of living is so high that there might not be a whole lot left over. Then again, if you're living in Sydney making 250 as a couple, you could say the same thing, I suppose. So what do we have here? The married filing joint taxpayers in the New York, they're paying 27.2. They're paying 21,000 or almost 20, a little over $20,000 less in tax or taxes in this instance. And you'll notice I swapped. I said a taxpayer living in Australia, or taxpayers plural, because that could be a household. It could be two spouses under the same roof, where only one of them is working and one's staying at home. Next, let's compare a US married filing joint taxpayer who is in a state with no state or local taxes. Massive difference. And furthermore, we haven't even considered the standard deduction yet. So that's going to go down even more, but beyond the scope of tonight's presentation. Okay, so they're paying 54 versus 88 right there. What's that? $34,000 in taxes. Big difference. But we're beginning to see, and this is the whole point that I want to make here, we're beginning to see that there's a lot more that goes into the calculation. It's where you're physically located in the US, and your filing statuses are very important determinants of whether you're actually paying more or less tax, forgetting about the value of the dollar right now. Now, what if we took two single taxpayers making $500,000? We've got someone here in Manhattan. They're in a 42.9% tax bracket, so they're getting hosed, but that's what you pay living in the Big Apple. Compared to in Australia, the marginal rate is actually lower in Australia, surprisingly enough. What about in a state with no state or local taxes? That amount of total tax paid plummets by $42,000 and almost 10%. What about a married filing joint taxpayer living in Manhattan? So here's the couple making $500,000 versus a taxpayer. Again, this is just a household. We have one non-working spouse. Big difference right here. So 181 versus 205. What if we change it again, starting with a single taxpayer making $500,000? Let's see the last one. So married filing joint living in Manhattan. Next is single taxpayer making $500,000. in a state with no state, I think I got the order of these slides little messed up there. Single taxpayer making 500,000 in a state with no income tax would be 163 versus New York. Oh, sorry, I'm going to go back. In Manhattan, yeah, so you see a 181 difference right there, or sorry, 181. So $18,000 approximately is what they're saving on being out of state to New York. And the last example is the best one, save the best to last. So what we have here is a married filing joint taxpayer making $500,000, living in a state with no state or local taxes, compared with someone in Australia doing essentially the same thing, and they're paying significantly less. So $73,000 difference right there. Brett writes, plus many possible deductions. That's right, such as interest paid on primary residence. True, but not true. Brett, maybe. You're not yet again, you got me. Not technically wrong. I can't say that is incorrect. But what changed in 2017 was when Trump introduced the Tax Cuts and Jobs Act, and he did away with personal exemptions and more than doubled the standard deduction. That had the effect of reducing the number of people that can choose to itemize their deductions versus taking the standard deduction. So the key here, and by the way, they they limited the amount that you could use as a deduction for state and local taxes to $10,000. So that was capped at $10,000. I'm actually going to hold off on the rest of the answer until a slide towards the end here, because I get into the difference in deductions. Okay. So what we're looking at here is the taxation of capital gains. And I've already been over this a little bit, but I wanted to just share this additional bit of detail. In this day and age, most assets, except for primary residences, it's not every day I'm going to encounter a client who's held onto some investment asset, be it an investment property or a stock, who's had that before 1999. So I tend to revert to simply saying that the way Australian capital gains tax works is you get half of your marginal rate. That's basically it. So we take these brackets that we see right here, cut them in half, and that's your long-term capital gains rate. Of course, we don't get that if we're a non-resident. There's been another Q&A. Diane Matthews writes in, will this recording be available to view later? Diane, that tells me that you were not here at the beginning of the presentation, because the beginning of every presentation, I say that we record every presentation and upload that to YouTube. If you've registered for the webinar, we'll send you an email to let you know that it's up there, because some of these things, some of these things are boring and technical, and you might like to pause your screen when looking at it to see the exact amounts used in the charts here. Okay, so that's capital gains in Australia. I put together this chart, which is probably one to your question, Diane, there about wanting to pause and take a look at. I'm just closing a few of these questions, but leaving Brett's open so I can come back to that. So what are we talking about here? If you're in a marginal tax bracket of 32.5, 37, or 45 in Australia, and here's your AGI, well, in Australia, they don't call it AGI. Here's your gross, your taxable income. You're making less than 120 to be in a 32.5% bracket. You're making less than 180 and more than 120 to be in a 37% bracket. And you're making more than 180 to be in a 45% bracket. The long-term capital gains rate in Australia is as simple as dividing that by 2. And so we end up with these percentages right here. We're just focusing on the Australian example for the moment. Okay, if you were looking at a $10,000 gain, a $100,000 gain, or $1 million gain, what would your marginal rate be for that capital gain? Well, if it's a $10,000 gain, I'm going to assume that keeps you under 120, and so you still only pay half of your marginal rate, and you're still simply paying 16.25. What if it's a $100,000 gain? Okay, now this is where I'm stretching it a little bit, because remember your taxable income needs to be under 120. So that's to assume this is a year in which you've only got $20,000 or less than $20,000 taxable income from other sources, because your $100,000 gain would push you over 120 and bump you up into the 37% marginal rate. So with the $100,000 gain, we're saying you still stay in the 16.25% bracket. $1 million gain, there's not much you can do, but you know what? No one's crying too hard for $1 million gain. Of course it's going to push you past $180,000 into the highest marginal rate. So you're paying 22.5%. You just blew up your capital gains rate, but really not that much. You're still only talking about a 6.25% difference from your rate from the 32.5% bracket to the 45% bracket. So that's pretty good. And essentially what we're seeing is the same thing as we walk along. So in Australia, you're really capped out at that 22.5%, plus the Medicare levy. There's another 2% on top of that, but strictly speaking, this is just the capital gains component. Now, the US gets a little slipperier, as you heard me say earlier, because they don't apply capital gains rates according to your bracket. They apply it according to an amount of AGI, adjusted gross income. So less than 89,250 married filing joint, I'm talking about here, excuse me, I should have put in MFJ, and you're in a 0% long-term capital gains bucket. So therefore, let's say you have a $10,000 gain, total AGI less than 89,250, or actually 79,250 to experience a $10,000 gain and still be under the bracket, you're paying 0%. By the way, I just want to flag this. This is where tax planning in retirement is so valuable, because you can really, especially in the years before Social Security kicks in, you can really control your income and therefore control your capital gains tax. So if you had no other income from any other source and you had let's say an $89,000 gain, you could put that through capital gains tax-free and possibly save about $14,000 compared with what you would have had you been bumped up into the next tax bracket. So quite a broad bracket between 89 and 523 for married filing joint individuals. Just halve these numbers for single filers. You'll get the same result. That's but not for the top rate. That's just for the 0 and 15% rate. Okay, so you're paying 15% there. Above 250, this is where it gets extra complicated. My goodness, rules versus principles. So above 250, married filing joint, 200,000 single filers, you also have to contribute your fair share to the Healthcare Act, to the Obamacare that came in. So there's a 3.8% net investment income tax on the lesser of income or investment gains over for taxpayers who have an AGI or a modified adjusted gross income in excess of those amounts. What a mouthful. Okay, so this is what I said way earlier in the presentation, how the US can end up, and in fact does end up, with a higher capital gains rate than what Australia does, because you've got 20 plus 3.8, 23.8 higher income earners who've got big gains. They're actually paying slightly more in the US than they are in Australia. Okay, another question appeared, so I'll just see if that relates to what we have here. Brian Marshall, hi Brian. Withdrawals from a 401k, US-based, yep, I'm well aware, treated as income in Australia, and are they taxed as well in the US, or are there limits on taxation? Brian, congratulations. I have done webinars just dealing with that exact topic. The short answer is it depends on your legal status. Are you a citizen or green card holder back in Australia? If you are, then you've got problems, Jack, because you're going to be paying the US side. And if there's a difference in tax owed, then you're paying the Australian side too. Bad news. Whereas if you were only in the US on a temporary visa when you accumulated your 401k, then you moved back to Australia, you said, thanks so much, I don't intend on returning to the US. Here's my visa, it's expired anyway. Then the treatment is different, because you can exercise a distribution using the income tax treaty between Australia and the US. And that's all I can say at this moment. We have to get into a whole webinar to talk about that. Katrina, does that apply if the Roth has already been taxed? You know, it does, Katrina, and here's why I can tell you're not a long-time follower, because I've also covered that in detail previously as well. We don't like Roths for returning expats, and I say returning expats meaning returning Aussies or Americans moving to Australia. Why? Because Roths can end up getting double taxed. They get the tax preferential growth and distribution when you're in the US, but when you come to Australia and you're an Australian tax resident, the ATO looks at this and says, we don't know what to make of this thing. There's no Roth IRA in the ITAA of 1997. We're going to treat this as a foreign trust, exactly the same way we treat a 401k, which means that the employee contribution, the employer contribution is deemed as the taxable basis. Any growth above that is taxed at ordinary income levels back in Australia. So bad news on the Roths. I read something about, I love when people read something about non-residents do not pay tax on capital gains of Australian stock sold. Wrong. Perhaps I misunderstood. No, it's possible you didn't misunderstand. It's possible that whoever wrote that is just plain wrong in the first place, Brett. And that's the thing, is this is one of these nuanced examples. Did that individual hold those stocks when they left Australia? If they did, it's taxable Australian property and they have a tax obligation back to Australia. However, if they were in the US and they said, well, gosh, I'm looking forward to moving back to Australia. I'd like to start an investment portfolio back in Australia. I'm only going to invest in individual stocks there because I listened to this webinar from Arete Wealth Strategists and Ashley, where he warned me about investing in passive foreign investment companies. They're bad news, so I'd never do that. Now, what if I invested in Australian stocks from the US? Different story. So you wouldn't get a step up in basis on that because it's already known to be Australian property and they can determine the basis, which is why I wouldn't recommend doing it in the first place. That is a move I would say is too clever by half. If I was at a barbecue and someone said that, I would kind of think it through and say, yeah, there's no point in doing that, because if you were in the US on a temporary visa in the first place and you had a US stock portfolio, you come back to Australia, surrender your visa, you get a step up in basis to the fair market value at the time you resume Australian residency, which beats what you're talking about there every time. Anyway, okay, still haven't forgotten about Brett's original question there at the top, which I'm getting to on the next page. So let's get to it without further ado. Here's the deal. In the US, the income tax formula is really quite similar. It's not identical. We don't use all the same acronyms and nomenclature. There's no QBI. That's another freebie that was thrown out in the Tax Cuts and Jobs Act. I'm not complaining. I'm a beneficiary of it, as are many other business owners around the US. But that's a qualified business income deduction. Very complicated to figure it out, but it helps lower your taxable income. So both the US and Australia allow certain expenses to be itemized and reduce your taxable income. But the big difference is that the US offers a standard deduction. This is the deduction that everyone gets. If you're a single filer, it's $12,950. If you're a joint filer, if you're a married filing joint filer, you get $25,900 just instantly deducted. So I'm gonna try and provide a simple example, just talking to you here. Let's say you make $100,000. You're married filing joint. You live in Manhattan, as was looking at earlier. So you're in a 22% bracket, is it, at that level? You're getting taxed at that level at $100,000. Will you instantly reduce your taxable income by $25,900? And you don't need to show any receipts. You don't need to show any statements, nothing, because you just took the standard deduction. So while your gross income was $100,000, your taxable income will be $74,100. So that's another very important distinction that we need to make when trying to compare tax systems as we are here. I feel like now is an appropriate time to look at Brett's question again. Plus many possible deductions in the US, such as interest paid on primary mortgage. Now here's the thing, Brett. I don't know if you're aware of this or not, but the thing with the US is you can't choose whether to, well, that's not true. Technically, yes, you can choose, you'd just be leaving money on the table. No one would choose to do this, of course. You have to have itemized deductions that exceed the standard deduction for it to make any economic sense to itemize in the first place. I've never heard of anyone itemizing when they have itemized deductions that total less than the $25,900, because why would you do that? It's driving up your tax bill. So the mortgage interest in today's interest rate environment, if you've gotten a mortgage recently, that could be a lot easier than it used to be, say 2 or 3 years ago. You're limited to $10,000 in state and local taxes that you can include. SALT, state and local taxes is what they call it. 10,000 cap there. They also capped mortgages too, Brett. So your mortgage is only deductible up to $750,000. So if you take out a mortgage above that, the amount above it is capped. So you can only count the interest on that $750,000 amount. So it's not as simple to say that you can just itemize willy-nilly in the US. It's a pretty high bar that you need to reach to be able to itemize. Okay, so I'm going to say that question's answered and move along. Okay, and the okay thanks suggests it is. All right. So if you're interested in learning more about what we do, who we work with, please come to our website, click on the Get Started, and schedule a complimentary 15-minute call. Do join me next month for October's webinar, where I'll be going through key financial planning moves for high net worth individuals and families seeking global mobility, covering a range of topics. This is kind of a compilation of webinars and deep dives that I've done previously on investing and taxes, on the types of investments you can get into, real estate and how that works in this context, issues affecting the children of the globally mobile, and estate planning. So I hope you can make that. If you've signed up here tonight, you'll receive notification of that webinar. We have updated our key financial data sheet, which you can access here at the Knowledge Center, along with various other flowcharts. And I'm going to be adding white papers in the coming months, but that's what I had prepared for you tonight, and right on time. I want to stop and see if there are any more questions. And good to see some familiar faces here, or names, I should say, at least. Joyce, Andrew Russell, Astrid, good to see you, Astrid. Who else do we have here? David, I recall speaking with a while back. John Oyston, good to see you here. Margot, of course. Nancy, hope you're well. Let me see, that might be it. Okay, so if there are any other questions, I'd be happy to answer them now. Otherwise, I hope you can join me next month. Have a wonderful, oh, hold on, the Q&A, they're coming in. I was just about to say goodbye. Margot writes, and thank you for the anonymous attendee, congratulations. Worth noting that the standard deduction cannot be used in an expatriation year, dual status US tax return. Thank goodness for Jordan Friedman, who knows that. I did not know that. That's news to me. A standard deduction cannot be used in an expatriation year. Okay, thank you, Margaret. Appreciate that. I know you've got a war story with your own expatriation, how that went. Can you help with tax plan for US and Aussie? Tax plan, yes. Tax file, no. There is a difference. We don't submit taxes, never have, never will. But we're certainly mindful of them, as I hope you gather tonight. You know, I also think this is especially high praise, because I have to say, taxes can often be the most boring conversation here in financial planning. So the fact that someone said that was so great, thank you, that really hits home. All right, everyone, have a wonderful rest of your evening, and we'll look forward to hopefully seeing you next month. Bye-bye.